Hello, I'm Yushi Peng. I'm a PhD candidate at the University of Zurich and the Swiss Finance Institute. In this video, I would like to briefly present my work, mortgage credit and housing markets. In this paper, I studied the research question, how mortgage credit conditions affect housing markets. For example, housing demand, prices, the market liquidity, the bargaining power between buyers and sellers. And what is the role of expectations in housing markets? There are several challenges to answer these questions. First, mortgage credit conditions are very likely to be endogenously determined by housing demand and prices. That makes causal statement very difficult to make. Moreover, households face a dynamic problem instead of a static problem. Expectation of future prices can affect the housing market outcomes today. And houses are very special. They are illiquid and heterogeneous. Therefore, there is a high transaction cost and searching cost in this market. To address these challenges, I built a dynamic structural model to estimate the utility and the value function of property ownership. The model can disentangle housing supply and demand and help us understand the structure of housing markets. In the counterfactual experiments, I also study the impact of mortgage credit conditions and the role of expectations in housing markets. In the model, I consider households, they are either property owners or non-owners. For property owners, they have some probability to become seller by listing their property in this market. For non-owners, there is also probability to become a buyer. After a buyer enters into a market, he has to decide which property to purchase. Property types depend on characteristics like size, location, and age. A type of property will generate utility data every period for the owner, and the value of owning a property is the sum of discounted future utilities. After buyer choosing a property type, he will make bids for those properties. Every time period, the seller has a probability queue to receive bids. In this case, she will be in the decision states. She can decide whether to sell or not. Notice that the seller can receive more than one bid. If she decides to sell with probability P, it means she accepts the highest bid. With probability 1 minus P, she will reject all bids. If she has not received any bids, she's in the waiting state and she has to wait. In these two cases, the seller has an option to sell in next period. In other words, the seller is solving her optimal stopping problem. After selling the property, the seller becomes a non-owner, and there is a probability to become a buyer. Therefore, the model allows home switchers. I use data from a Chinese real estate service company. The sample contains transactions in 15 cities from December 2015 to January 2018. There are detailed information on listing and transactions and property characteristics. I also use mortgage data of large banks in China. This figure presents the estimated market liquidity and the bargaining power for sellers. You can see that there are some cities like Shanghai that have low market liquidity, and the relative bargaining power for sellers is also low, because in Shanghai, the probability of receiving bids is low, and conditional on receiving bids, the sellers are willing to sell. This suggests that Shanghai is a buyer's market. And in some other cities like Tianjin, the market liquidity is higher, and the seller have higher bargaining power, because in this city, the probability of receiving bids is very high compared to seller's probability of selling. This table shows the estimated parameters for per period utility. Interest expenses have a negative effect on utility, and households prefer larger or younger properties. On average, households are willing to pay 800 Chinese yuan, approximately 110 USD more per month for a larger property type, and roughly 70 USD more for a younger property. In counterfactual analysis, I simulate a 10 percentage point increase in down payment requirements. And I consider two scenarios. The first scenario, no expectation, will only increase the mortgage credit condition in utility function and keep the expectations fixed. In the second scenario, I will allow expectations to change. The table shows that when the down payment requirement is increased, the probability of receiving bids dropped and probability of selling increased. Housing demand dropped, housing supply increased, and house prices dropped. When we allow expectations to change, we find the magnitude becomes smaller and the standard deviation becomes larger. That means on average, expectation mitigates the effect, and it has different effect in different markets. I find similar results when I simulate 1 percentage point increase in mortgage interest rates with a smaller magnitude. In summary, this paper studies how mortgage credit conditions affect housing markets using a dynamic structure model. The mortgage interest expense have a negative effect on the utility of home ownership. Higher down payment requirements have a negative effect on value of home ownership. The counterfactual exercise show that higher mortgage interest rates or down payment requirements reducing housing demand, increase house supply, decrease house prices, and decrease market liquidity and sellers' bargaining power. The expectation play an important role, and on average, it mitigates mortgage credit policy interventions. Thank you for watching.